Hi, I'm Ross from Coombe Smith Property Accountants in Hamilton. I'm going to speak about saving on interest today. So obviously interest is a big cost on your personal home, and it's also a big cost on our investment properties. So it's important to get it right and try and save as much as we can. So the first thing I do is look at interest.co.nz and look what the standard rates are. So at the moment the rates go from about 4.45% down to or up to 5.8% for the 5-year rate. So if we have three standard loans, we have three $300,000 properties, and we have them floating with Westpac, Sovereign and SBS. They're all sitting about 5.9%. So our interest for the year would cost us $53,000 or average about 5.91%. So obviously that's not the best. So what we're looking at doing is, can we do better? And the obvious answer is yes. We can go through a broker, or we can even just ask our bank, can you please give us a better rate? Or my favourite excuse, my accountant told me that rate is way too high and that I should get a big discount off it because I'm a great customer. So generally the broker rates are a lot lower than the standard rates. So they can get quite a discount off all of those. So if we apply that to our example, what we might do is we might go for the best rate at the moment, which is about 4.25%, and we might fix all of them for 1 year. So the costs come down, instead of being 5.84%, it comes down to 4.25%, and it saves us about $5,000 on each of the loans, about $15,000 overall. So that's obviously one approach that brings our average interest rate down from 5.84% down to 4.25%, which is good. The next thing I sort of look at is, should you be putting all your eggs in one basket? Do you really want all your loans on a 1-year rate, or is it better to spread them? So we might do 1/3 short, 1/3 medium and 1/3 long. And I also quite often do this in two, so it might be half long, half short. So the example might look something like this. Through a broker, we might fix the first loan at 4.25% for a year, and the next loan at 3 years at 4.79, and the last loan at 5 years for 5.29. So we're getting a real spread. We've got 1 year, 3 year and 5 year rates. And overall on each of those, we're still saving about $10,000 based on the floating rates, but we've got a better spread. Our average interest rate's higher at 4.78%, but it's still a lot better than the floating rates. And yeah, it also means that we've got a better overall package in there. There's just a slight mistake on one of my slides. It would actually be 5.84% still the average over, the same as what it was before, 5.91. So some key concepts. Floating often costs a lot more, as we've just shown. So by looking at other rates, you can often save a lot. Consider your personal circumstances. So if you're going to sell your rental and you know you're going to sell it in a year's time, there's no way you want to fix for 5 years. You want to align that with your period you're going to sell for. And the same, if you had a high income or expecting to win lotto in the next few weeks or have a big inheritance or something coming through, then you would plan for that, and you'd make sure you've got some shorter term loans that you could put that cash in. And it also means that you could be more aggressive. If you know you can pay off that loan quickly, then you might take more of a gamble on the shorter term rates. And what I often find is people want certainty. Rather than the best rate, you'd like to know what the payments are for the next 5 years. So that can often give you an advantage with planning and budgeting. If we compare 1 and 2 year rates, 2 year rates 4.4%. So if we fix for 1 year at 4.25% at the moment, and then next year, the second year, the interest rate went up to 4.55, and that was the best we could fix for 1 year. That would basically be exactly the same as 4.4%. So that would be the comparison of what you'd need for two 1-year rates versus a 2-year rate. So if the second year rate is above 4.55%, then it's going to be more expensive, and it would have been better to fix for 2 years. If the second year rate is below 4.55, then it would have been cheaper to fix for the 1 year. If we look at the same thing for 5 years, you could fix for 5 years at 5.29. So if we just guess some rates, and I've just listed them out there, what I think they could be over the next 5 years, The average of those would be 5.21%. So if your interest rate goes up 0.5% a year for each of the next 5 years, it actually still works out cheaper than the current 5-year rate. The big thing with this whole thing though is it's a big guessing game. I don't have the perfect answer, you don't have the perfect answer, none of us have a crystal ball. So rather than guessing that it's going to stay low, go high, that's why I like the spreading approach. You're effectively not gambling on either, and you're covering yourself whether interest rates stay high or whether they go down as well. If you're after some more information, our website's got some great information on it, and we also post a lot on Facebook. So if you like us on Facebook, you can get a lot of good information. Our newsletter that comes out every 1 or 2 weeks has some great information about property. And obviously, important thing at the moment, this is done as at August 2017, so it's current at the moment, but the same concepts always apply. So generally, floating is always higher, and it's always good to spread your interest rates. Also, we've got an offer on at the moment. If you think that you're not getting the best property advice, if you email my PA, Maurice at cswaikato.co.nz, we can organise a free 5 or 10 minute chat just to see what we can do to help you, and whether we can help you get ahead with your property investment and save some money on interest and tax as well. Thank you.